Large real estate companies like Blackstone are strategically choosing to stop paying their mortgages on commercial properties across the United States. As a result, there has been a significant drop in property value. In fact, commercial real estate prices have decreased by a whopping 22% in just the last 15 months. The decline in the commercial property market has primarily affected apartment and office buildings, causing their values to drop by 30 to 35% from their highest point. The reason for this is these corporate landlords' deliberate and calculated actions. This sudden crash in the commercial property market has far-reaching consequences and is something that could cause a massive contagion effect through the economy in 2024. If commercial owners are forced to close their shops, it could lead to a domino effect, with banks being forced to shut down as well. This scenario would result in a substantial increase in unemployment, significantly impacting the overall health of the economy. If you're a business owner, you may want to be cautious about investing in commercial property right now. It's essential to monitor the market trends and understand the risks involved in this sector. The United States banking industry may suffer a massive blow of around $160 billion due to the collapse of the commercial real estate market. This downturn could be the greatest since the last financial crisis that occurred in 2008. It's a daunting and frightening scenario that shouldn't be overlooked, as it could have dire consequences. Many people are optimistic about the economy, believing we've dodged a bullet. However, research reveals that massive issues are developing across various sectors of the economy, particularly within commercial real estate. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Large companies such as Blackstone, the largest alternative investment manager worldwide, with assets worth more than $1 trillion, are beginning to walk away from their commercial properties. Such occurrences are very alarming and signify that something is amiss. The situation is expected to escalate and could cause cascading effects, leading to a recession in 2024. It's a dire scenario that's likely to harm the economy severely. Blackstone seems to be facing imminent default on a prominent piece of real estate investment in Las Vegas. The property in question is a humongous office center called the Hughes Center, spanning 1.4 million square feet and located just east of the newly built entertainment complex, The Sphere. Despite its prime location, this property has been struggling with a high vacancy rate of 42%. In fact, more than half of the office buildings are empty, posing a significant financial challenge for Blackstone. As a result, they had to stop making payments on the staggering $325 million loan tied to the office park. This decision has catapulted the property into special servicing, the last resort before foreclosure. It seems the company is on the brink of losing this remarkable piece of a real estate investment. You might be wondering what's happening in the world of commercial real estate lately. And it's not just Blackstone. Commercial property values all across America have been plummeting, not just in office buildings, but also in apartments. The reality of this situation is that it's not looking good for the economy in 2024. When we see such a drastic drop in valuations and equity, it's likely that there will be a ripple effect throughout the economy. This is because the economic landscape is interconnected, and the problems in any one sector can adversely impact others. But what's causing this drop in commercial property values? Different factors are at play, but some main ones are changes in consumer behavior, shifts in the job market, and uncertainty about the future. Let's explore these factors in more detail, such as shifts in the consumer behavior. Due to the pandemic, a significant number of individuals have shifted towards online shopping instead of traditional physical retail. This has led to decreased demand for commercial properties like malls and storefronts. Another factor is changes in the job market. A growing number of individuals are now working remotely. Consequently, businesses may find that they don't require as much office space as they did before. Additionally, specific industries such as hospitality and tourism have been severely impacted by the pandemic, leading to reduced demands for commercial real estate. And finally, uncertainty regarding the future. The pandemic has generated a sense of anticipation across various aspects of life. Businesses might be reluctant to invest in commercial properties given the uncertainty surrounding the economic future. So in the coming years, we can expect a contagion effect to take a toll on the banking system. This trend will be particularly noticeable in 2024 and the subsequent years. But how will this happen? As we all know, when huge losses occur, someone has to bear the brunt. And in this scenario, that someone refers to the banks in America, or dare we say, the taxpayers of America when the banks are bailed out. According to reliable data from the Federal Reserve Bank of St. Louis, the commercial real estate loans on bank balance sheets today amount to a staggering $2.9 trillion. This number indicates the amount of money banks invest in commercial real estate, including offices, apartments, retail stores, hotels, and industrial spaces. Over the past 4 to 5 years, this figure has surged to its record high and now stands at almost 50% higher than the bank's exposure in 2008 at the peak of the last bubble. This high level of investment makes these loans vulnerable to higher default rates if the economy experiences a downturn or bubble burst, leaving banks facing huge losses. Experts forecast that commercial landlords may have difficulty paying off their apartment building loans as interest rates surge. As a result, they may have no other way out except to sell their properties to repay their debts. This foreclosure scenario is a cause of concern, as it could lead to a significant loss for banks that lent money to these landlords to invest in properties. If the property is eventually sold at a price lower than the mortgage amount, the bank will have to bear the brunt of these losses. Banks may struggle with liquidity and solvency issues, triggering a domino effect of further losses, leading to a severe financial crunch. When banks start reporting their losses on their income statement, it may cause panic in the market, leading to further economic shocks. The real estate market's collapse could have a cascading impact on the broader economy, leading to job losses, reduced investments, and lower consumer spending. There is a looming possibility that we may witness another banking crisis, which could potentially be much worse than the one we experienced 8 to 9 months ago. During that time, we went through a mini banking crisis where a couple of banks in America were forced to shut down. As a result, depositors began withdrawing their money, which led to concern about the liquidity of the economy. Monetary credit subsequently dried up. Fortunately, the Federal Reserve stepped in and plastered over the issue. However, it's important to note that this may not end it. There is a very real possibility that the current commercial real estate crash could trigger an even more severe banking crisis in 2024. The National Bureau of Economic Research recently conducted a study to evaluate the risks associated with commercial real estate loans. According to their findings, 14% of all commercial real estate loans are currently in a negative equity position. Furthermore, 44% of all office loans are also underwater, representing almost half of all office loans in the country. The study also highlighted the dire consequences that could result if we were to experience a default rate of 10 to 20% on commercial real estate loans. This range is comparable to the default rate seen during the Great Depression. In such a scenario, additional bank losses could range from $80 to $160 billion. Such losses could push as many as 300 small regional banks into the danger zone, leaving them vulnerable to solvency runs and other risks. This is certainly a problematic situation that needs to be addressed by all stakeholders in the commercial real estate industry. Jerome Powell, the current chair of the Federal Reserve, and his team are well aware of the various risks lurking in the background. Although they might not always discuss these risks openly during their press conferences, it's on their radar. The Federal Reserve constantly monitors the economy and the numerous factors that can impact it. Hence, they're closely monitoring the signs of any possible disruptions that could cause problems down the line. Although these risks may not be the main topic of discussion during their public appearances, it doesn't mean the team isn't thoroughly considering them behind closed doors. As highly trained economists, the Federal Reserve is constantly analyzing data related to the economy, including that of the commercial real estate and banking sectors. Based on their research and analysis, Jerome Powell and his team have started signaling that they plan to reduce interest rates beginning in 2024. There's a sound reason behind this move. They see what's coming on the horizon. One of the biggest reasons for this shift in interest rates is the imminent risks that could arise within the commercial real estate and banking sectors. The team closely observes these potentially negative developments, resembling a slow-motion freight train headed to a destination no one wants to reach. If we consider lowering interest rates a couple of times this year, there may be some relief from the current pressure on the banking system and the commercial real estate sector. This could help avoid a major crisis, but we can't be certain because the wheels may already be in motion. The value of commercial properties is decreasing, which is a daunting situation we're facing right now. A new report shows that office building values have decreased significantly year over year in many major cities. For instance, San Francisco experienced a 60% decline in value, while Chicago, San Jose, Philly, LA, Dallas, New York, and Boston saw declines ranging from 31 to 48%. These numbers do not lie and represent a genuine crash occurring in the office real estate sector. The decline in office space value is a serious concern and indicates a significant disruption that needs immediate attention. Right now, we're seeing a massive loss of equity in the hundreds of billions of dollars. The reason is evident. Office values are rapidly declining, a trend attributed to the impact of the pandemic and the emergence of the new remote work trend. Even with some companies calling their employees back to the office, it seems most workers are still operating from their homes. We're experiencing only about 50% office occupancy across the board compared to what we had before the pandemic. What implications does this hold? Well, tenants occupying these office buildings don't require as much space as they did before, which means they don't need to renew their leases. The office vacancy rates are increasing as a result, causing many of these towering buildings to sit empty and unused. The phenomenon is not limited to small towns. It's also occurring in cities, notably in places like San Francisco, where office availability rates have reached an astonishing 35%. Did you know that San Francisco has around 30 million vacant office spaces? Surprising, right? And the situation is no different in Nashville, where a whopping 48 million square feet of office space is available. That's a lot of empty real estate. In fact, 27% of available office spaces in Nashville are currently unoccupied, which is higher than the average 23% availability rate in the U.S. Houston is facing a challenge where a significant 200 million square feet of office space is available, but unfortunately, 30% remains vacant. Similarly, Denver, Dallas, and Austin have a similar issue, wherein there is a 30% vacancy rate in office spaces. Even in Atlanta, the office vacancy rate is slightly higher at 32%. These alarming vacancy rates pose a colossal problem that is not expected to get better anytime soon. The pandemic has altered the world's landscape in countless ways, and commercial real estate is no exception. The general consensus is that there is a new normal regarding how much office space companies need in the post-pandemic world, and it's not as much as it once was. The decreasing need for office space is a direct result of the pandemic. It's a fact that many companies have adapted to remote work, and much of their operations are now managed virtually, cutting down the need for physical office space. However, the vacancy rate is not the only issue. There's another concerning development, and that is the drop in job postings from companies looking for office workers. This drop indicates companies choosing to reduce their workforce's size, opting for virtual and remote workers, and this trend appears to be gaining popularity. A recent report from Avison Young has revealed some concerning trends in office employment. Despite a significant increase in office employment, 65% higher than pre-pandemic levels, job postings have plummeted by a whopping 21%. This indicates that many industries are still struggling to regain footing after the pandemic. When we look more closely at the data, we can see that certain industries have been hit particularly hard. Companies in the consulting, media, banking, law firm, and tech sectors have experienced a staggering 33 to 50% decrease in office job postings over the past 18 months. This suggests that these industries still face many challenges as they try to recover from the disruptions caused by the pandemic. The National Federation of Independent Business is presenting a concerning revelation about the state of small businesses in America. According to the reports, the net percentage of small business firms increasing employment has been negative since March. This means that more firms are decreasing their number of employees than those adding more. Interestingly, their findings starkly contrast with the jobs data from the Bureau of Labor Statistics in the last few months, which has painted a much more optimistic picture of the economy. This signifies a clear divergence between what the U.S. government reports in their unemployment statistics and retail sales figures versus the actual experience of independent organizations, small businesses, and many companies and people in the economy. This revelation is particularly alarming since small businesses are the backbone of the American economy. They provide approximately 50% of all private sector jobs and contribute to the nation's economic growth. Due to the pandemic, small businesses have been disproportionately affected and many struggle to survive. Mainstream news sources may not cover it, but recent data from the Small Business Optimism Index reveals some concerning trends. As we begin 2024, many small businesses report collapsing incomes and revenues. In fact, the earnings of small businesses have hit their lowest level since the pandemic and the 2008 financial crisis. This information was gathered through a survey of small business owners over the last 3 months. They were asked a simple question: are your earnings higher or lower? Unfortunately, most responses were negative, indicating that small businesses struggle to keep their doors open. The National Federation of Independent Businesses also conducted a survey that revealed a staggering 32% more small businesses reported a loss in earnings than made actual profits. This percentage is alarming and one of the worst recorded in the history of small businesses. The fact that small businesses are struggling to make ends meet is indeed a cause for concern. Even more concerning is the fact that this trend of dipping earnings has continued for far too long, leaving business owners to wonder if there is any light at the end of the tunnel. As a result of this survey, the need for support and assistance from all relevant authorities, including the government, cannot be overstated. These businesses form the backbone of our economy and the voice of local communities. Without a robust and healthy small business sector, we risk losing the very essence of what makes our communities thrive. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below with your thoughts.